Hi, everyone. Hello, hello. All right, let's get started. Hello, everyone. My name is Allison Tate. I'm a certified financial planner professional, and welcome to my first ever live event. I am the owner of two firms, a very tax planning and a very wealth management, which are firms who work with business owners to help grow and protect their wealth. So today I'm wearing my tax hat and wanted to take a few minutes to discuss some additional deductions that you could potentially take on your tax return if you are an entrepreneur. So this year I started working with a bunch of new tax planning clients. And so my normal process is I take the data that they give me, input it into the return, and then we normally have a call. And that call is normally to review the information, but also to discover whether or not we've missed any potential deductions. And through all of those conversations, several themes kept recurring. And they all said, well, these are not expenses that my previous tax preparer ever told me about. And so in my thoughts, if a handful of people tell you that this is not something that their previous tax preparer told them about, then it's quite likely that there are a number of other people who aren't aware of similar deductions. So I just wanted to take a few minutes this evening to walk through five of those commonly missed deductions. So let's get started. So the first is self-employment health insurance deduction. So that's right. If you are self employed and you are paying for health insurance, whether on the exchange that you purchased on the exchange for yourself or yourself and your family, you have the ability to deduct those insurance premiums on your tax return. You don't deduct them on Schedule C, you take them as an adjustment to your income on the 1040. So that's the first one. Health insurance can be very expensive. So a lot of people were amazed that they could potentially deduct thousands of dollars from their income on their tax return. So let's get into number two. The second is the home office deduction. So if you are an entrepreneur and you work from home, and you have a dedicated workspace. So it can't be like your kitchen table that your whole family uses every day, all day. If you have a dedicated workspace in your home, you have the ability to potentially write off your rent, your mortgage. So this is how you do it. So you look at the total square footage of your office space and you divide it by the total square footage of your home. So let's say, for example, your office is about 300 square feet and your home is 2,000 square feet. So that's 15%. So essentially, you can write off 15% of your mortgage interest, your rent, your utilities, your electricity, your water, your internet. If you have an alarm system on your home, if you get a housekeeper who cleans the whole house, including your office, you can deduct 15% of that cost. Now, if you don't want to go through all the receipts to calculate like how much you spend on utilities for the year, because I understand that gets a little overwhelming, there is a simplified method that you can use. And under that simplified method, you basically take, I think it's roughly like $5 per square foot. So let's just say, using that same example, $5 times, 300 square feet, that's, basically $1,500 that you could potentially deduct. Using that simplified method, $1,500 is actually the maximum amount that you can actually take. And you would take that home office deduction on your Schedule C. So that's essentially how you write off your mortgage and your rent. The third item is a SEP IRA deduction. So, leveraging a SEP IRA is going to be a really powerful tool as you plan for retirement as an entrepreneur. So, you probably heard of paying yourself first. Well, this is almost like paying yourself last because you're paying yourself when you file your tax return. And the beauty of this is, again, you can make this SEP IRA contribution. You have up until the filing point of your deadline. So that means if you're planning to file April 18th, you have until that date to make the contribution. Or if you happen to put your return on extension, you have up until the time that you extend the return to make that SEP IRA contribution. So it's a really good way to kind of look at where your tax liability falls, and then you can decide how much you want to contribute to your SEP IRA. And so now there are some rules and kind of math involved to determine how much you can contribute, but I'll just say it's the lesser of 25% of your net self employment income. So your self employment income after your expenses. So it's the lesser of that net amount or $66,000. So let's just say your net self employment income is $100,000 after all of your expenses. That means that you can contribute a little over $18,000 to your SEP IRA. And you don't just, deposit the cash and let it sit. You want to invest it in the stock market. And let's say, for example, you earn 7% return on average in the stock market. Over 20 years, your $18,000 contribution will be almost $70,000. In addition, you investing in your SEP IRA today at that $18,000 level that I mentioned will save you about $4,000 on your taxes. So the beauty in this tool is that you can, save money now on your taxes, but also your future self will thank you later for having created a retirement nest egg. The next items are for rental properties. So if you are a business owner and you have a rental property and you've been preparing your tax return on your own, make sure that you are taking depreciation. Depreciation is kind of like an unknown expense because you don't actually pay it. So it's kind of like this phantom expense that most people don't even think about or are even aware of. And so they don't even deduct it on their return. Now, there are rules to determining what the depreciable value of your home actually is. And I won't bore you with that math, but let's just say that you determine that the depreciable value of the home, not the land, you can't depreciate the land, but if you determine that the value of the home is $400,000, you can depreciate that home over 27 and a half years, which means you actually have just found $14,000 of additional expenses that you can use to offset against your rental income. And the last item I wanted to touch on are travel expenses. So let's just say that you have a rental property that's out of state, preferably out of the country where in some warm climate. So let's just say you have a rental property that's out of state. You should be checking on your property at least once a year. So every time that you visit your property, no matter where it is, that whole trip is a deductible expense. So if you're driving out of state, you can deduct your mileage. You can deduct any meals that you eat while you travel to visit the property. If you have to stay in a hotel, you can deduct that as well. Now, why I mentioned rentals in like exotic locations, because just think about this for a second. If you had a rental property, let's just say in Mexico, and if you timed this right, you can essentially write off your whole trip to Mexico. That means the flight, the hotel, the meals, everything. And so, this is kind of one of the reasons why, you have a lot of entrepreneurs seeking rental properties in places that they want to vacation because it's like an instant write off for you. And if you have your family members working in your business for you, you can almost deduct like a family vacation on your tax return. So, those are kind of 5 things that I'm noticing are kind of commonly missed deductions on tax returns by entrepreneurs or those who have rental properties. I hope that this information was helpful to you as you prepare to file your return in April. If this live was helpful to you in any way, please let me know in the comments. I'd like to know. If you'd like to have me do more videos in the future, I'm happy to do so as well. I hope that you all have a good evening and enjoy the rest of your tax season.